All right. Hey, good morning, everyone. Welcome. We'll just kind of jump right into it. Um, I think what we're going to do today is try to get kind of out of our heads and center on just price action because there's so many fundamental people out there talking, and man, you can become schizophrenic reading all the stuff that's out there. I mean, the bullish stuff, the bearish stuff, just all of the different issues that are presenting themselves. Uh, I mean, it's impossible to figure out exactly what's up and what's down, right? I mean, you talk about the war in Ukraine, you talk about overwhelming supply, you talk about future crops coming in South America, then you talk about drought in Europe and in South Africa and in China, and you talk about drought in South America and the potential for La Nina. You talk about our drought and the variability of our yields. You know, it's a great crop. No, it's terrible. It's just everywhere, and so it can really mess with your mind. And so I think, and we've been saying this for weeks, we need to just let price tell us what the fundamentals are. Because remember, 95% of everything that's out there is is already being reflected in your chart. So we don't need to bang our heads against the wall trying to guess what the USDA is going to do and trying to guess what China is going to do with Taiwan and try to outguess all these macroeconomic events. We don't need to bang our heads and do that. We just need to relax and not fight our price action, okay? Now, so if we go back to corn and we go back several weeks, we've been talking about that this low right here was really significant at 577. And really, we wanted to see this shelf that existed from November, December, and January. We wanted to see this area hold, which it did. Now, this looks like a really precipitous drop, but only if you count it on the daily chart. If you start to look at the longer terms, which I'm going to do here in just a second, what you recognize is that this chart is actually a really healthy pullback in a much larger uptrend. So what do we see here today? Okay, what we've seen over since July 1 is just a really wide consolidation area. You know, and this is magnified because put it in perspective. This area here, 658 all the way down to 580, right? That is a huge range when in 2016, 17, 18, and 19, the entire range of all four of those years was like 60 cents. So the 4-year range was smaller than the last 60-day range that we've touched multiple times. So it makes it really hard to kind of keep your wits about you, right? But what we've seen off of the bottom here is we have a breakaway gap that has not been filled. You can count this as a 1, 2, 1, 2, and we're now starting 3 of 3, which is now 3 days into it. So this is calling for much higher prices. Now, I think today's low is really significant because if you come back to a prior congestion area, right, this is the congestion area right before the June 30 report. We consolidated for 1, 2, 3, 4, 5 days right here before we had this big drop. Today's low and yesterday's close was right at this level. This level right here is yesterday's close, okay? We consolidated dead center in the middle of the range and above the prior area of major breakout. So you can see we had major price expanse back here on March 31, right? What happened on March 31? Well, it was the crop report. So we broke out. The low of that day was significant. And that's even technically that was significant. It was significant because of the date. It's also technically here because this was a big price flip. So if you look at this level, this is where we closed yesterday. And I think that's really significant, and that's a level that we want to hold. Now, let's back out just a little bit and say, do our longer term charts convince us that we should be looking higher, right? And then if we are going to go higher, how much higher should we go? Well, on the daily chart, this is the 61.8% retracement at 689 from the peak to the trough. You can see that. That's 61.8. We should get up inside that. But the problem that we run into here technically is that now we're back inside the extreme of the first major break. And this would actually imply and support that this is, in fact, a 1-2-1-2, and we are actually going higher, and that this whole down move, this whole thing, was just a counter trend move. Now let's back out and let's look at the weekly chart of December corn, okay? Here's, come on, computer. All right, this is just the weekly chart of December corn, okay? Now, what we know is that we need 5 waves up to complete a sequence, and that this whole move here is 4. We've never even come into the weekly cloud, which is a very powerful signal. It's held it really well. This is that congestion area that we talked about. So wave 4 sold off and came back to a prior major congestion area that preceded a major breakout. It's exactly what you want to see. Now we're trending ourselves back higher. Here's your 61.8, and realistically, if this level right here gets violated, then we should pop right back up to the highs. Now, where does it count to if you end up breaking this high? If you break this 732 area, where does it count? Well, I don't want to get stupid and I don't want to get crazy, but there's some much higher targets. Could that be true? Well, let's walk through whether or not that could exist. You have all of the major satellite imagery companies and a lot of the independent forecasters forecasting a national yield below 170. And if you put that into our balance sheet, then that takes our carryout to under 6% stocks to use. That is way too tight. But that is also consistent with what we're seeing in the cash markets, which just continue to get stronger because the deficit continues to grow across the western and southwest corn belt. Now, will we be able to outgrow it? Well, guys, the Proforma crop tour already went through Indiana, Nebraska, and Ohio, and South Dakota. Okay, so in Indiana, which the USDA has at 190 or 189 point something, came in at 178 versus 193 last year. Nebraska came in at 158 versus 182 last year, and Ohio came in at 174 versus 185 last year. South Dakota 118 versus 151 last year. So unless Iowa and Minnesota and Wisconsin come in way above average, which maybe they will, maybe they won't, unless that happens, then price is just going to continue to discount the risk of a much tighter balance sheet. Well, what about demand, right? I keep reading these macro articles that say, oh my gosh, the cost structure is so high, we cannot stay in business. Well, it's not true for corn and soybeans because the margin expanse continues to be present. And so with profitable margins, we're going to continue to grind corn. We have not killed domestic demand, and the export market is looking to us because everywhere else has less supply than it did a year ago. So there's very little fodder for the bearish argument, in my opinion. Now I want to show you this. This is the weekly chart of the continuation. Okay, so this is always the front month most active chart. And if you have followed me for any length at all, we have talked about this a lot. Whenever the price of corn moves out of its daily cloud or its weekly cloud here, every time you see this type of setup, the average move is over $2 a bushel. And that goes all the way back to the beginning of my records in 1970. Your average move on a move through here, through the weekly cloud, is $2 a bushel from here. So where does that count to? Counts to 830, which is back to all-time highs, right? And if it does break that, then where do the targets off of this chart? Well, you've got 915, you've got 965. A few weeks ago, or a few months ago now, we did a lot of work on how far if you break a previous all-time record, how far do we go? And the answer is 38.2%, which would put us pretty much right in here to this 916, 950 area. Now, I'm not saying that that's exactly where we're headed, because I don't think that we have enough to get there right away, but that is how the technicals are lining up. So what can derail us, right? Well, a reversal below this peak at 681 can reverse it. Let's go back to our daily chart and look for where we might want to take some preventative action here, right? The 688 mark is a big deal. If we start to see weakness around here, we might hedge some, but I don't want to take the upside away, because I would expect it to put up a fight in this area. Because if this is a 1-2, 1-2, then what we're going to get is a 3, 4, 3, 4, and then on up into wave 5s. If that count is accurate, then we have a long way to go before we're done. Now let's look at Kansas City wheat, okay? Wheat is a very interesting phenomenon here too, and I've got a lot of stuff on this chart, so it's a little bit messy, but let's try to make some sense of it. Last week, this is last Wednesday, right, where I said, oh my gosh, hey, we're going to blow up higher. Well, market made us look really stupid for 72 hours when we dropped $1. At Market Chat, we were trading up here at Market Chat at 892 when we did it. By the end of the day, or by 8:32, we were at the lows. I mean, somebody came in and just absolutely annihilated this market, like 28 cents in a minute or two. And then we just had a free fall with a quick reversal. So we did take the bottom of this out, but then we immediately reversed and came back higher, which is a false breakout. And now we've traded all the way back up to the top of this range. Now, what should happen next? If this high right here, which was set on July 29th, and that high is 915, if this high breaks, then I would expect wheat to look a lot like corn does and just explode on up higher. Because whenever a big consolidation area gets broken like this, you should expect to move at minimum equal to the width of the consolidation area. So 915 all the way down to 811. So you got $1.04 from 915, right, which would take us all the way up into here. So I wouldn't be a bit surprised to see wheat explode up into that area and attack that high in relatively short order. It doesn't have to do that. The fundamentals really don't support it that much, but I don't think the fundamentals supported a lot of this down move either. Supporting that position is, in addition to corn, is this giant divergence. So here from July 6th all the way through last week, you saw lower lows, and all of your indicators and oscillators continued to trace higher lows. So as price declines and oscillators fail to go with them, we call that divergence, which when a divergence catches hold, that's what it looks like. And so as you start to break out, what are you doing? What are you doing in the market? Well, you're burying the shorts, right? Because now at this point, everybody that sold it last week is underwater. Everybody that sold it at any time in the last 2 months is now underwater. So as you break these peaks, they have to run to cover, and that entire short position has to come out so that it can, so that the funds can get back long. Now you think, well, they made lots of money to the short side. No, they did not. They were long all the way until this point, and they did not get short until just recently, if you go back and look at all the COT data. So the funds have a major problem on their hands here with corn exploding higher. I think they are caught short, and they are dead wrong on that setup. Now, I don't know what the catalyst is going to be to propel wheat higher, but that setup is not bearish at all. I don't want to be short wheat down here. All right, let's look at soybeans. Soybeans are interesting because, like corn, they're actually in a really bullish setup, but they have the weakest fundamental story of all of them. Our Pro Farmer Tour is actually showing pretty good bean results. There's nothing in the results coming from it that would say, oh my gosh, the USDA is wrong at 51.9. We're really at 48, right? There's nothing like that, like corn has been in. And so, um, uh, what's happening in beans, I think, is the fact that our demand keeps growing for them, not shrinking. As oil rises, we have pushed the crush margin out to $5 a bushel in places domestically. So the domestic demand continues to grow, the international demand continues to grow, and people continue to buy all of our beans in spite of the fact that we should have a wall of supply coming from South America. So beans could do a couple things here because they haven't been quite as strong as corn, right? But on the other hand, if they break this high at 1490, that's going to set up a challenge of this congestion area right in here at 1511. And if we do trade back up into that and corn explodes higher, it's hard for me to argue that beans are going to break and come back lower all the way down to 12 like you would read, right? I mean, if you read Twitter, beans should be free because we just have so many of them, and it's just anybody that owns them is stupid, and you're blind to the world. Well, price action's telling us the exact opposite, that the last thing you want to be for now is short. Well, what does our weekly chart look like, right? So here's the weekly chart of just November beans. The weekly chart's telling us that we're holding the daily cloud and getting ready for a major breakout to new highs because we're in a 3-4 just like corn is. So the problem with the daily chart is that we have this B2 sitting here, which would be a bearish count. But with this indicator, you have to be really nervous selling a B, because as these highs fall, this 5 will just move over and you'll have an extension of it. And those extensions can be very, very powerful. So that's why you've got to lean back onto your weekly chart and say, hey, this thing's in a 4 and we're holding above our cloud. We don't see any bearishness on this chart. We think this congestion area is more than likely to fall than it is to do anything else. And what about our continuation weekly chart? Well, it's the same setup. We've held the continuation daily cloud or weekly cloud, and we are coming all the way back up into this main congestion area. You know, think about corn, right? When I showed you that, corn is way below its primary congestion area. Relative to corn, this is where beans are trading. Beans are all the way back up into the summer congestion area, while corn is below it. So the weakest grain has the strongest price action, which is really interesting. Last thing I want to show you is this indicator down here. This is our force index. And what I want to show you is you've got, we talk about divergence all the time, where you have lower lows and higher lows. Well, here you've got a higher swing low and relative to this one, with a much higher swing low on this indicator. That's a very powerful buy signal and should propel beans all the way back on up. So for today, I don't see any reason to be overly nervous. I know a lot of guys are nervous about cash flow and just getting some things sold and booked so that you can get delivered and get paid timely for bank loans and all the good stuff. I have no objection to that. These are great values, and by all means, get to where you're comfortable. But my recommendation is stay as long as you are comfortable staying, because I think we got a lot more of this story to write. And if we do get a significant break, I think that's going to be a buying opportunity, not a sell, until we make new highs. And I'm going to continue to say that until we give up some of these weekly clouds, until we give up some of these major congestion zones that have been holding. So with that, I have one more minute to go, and I want to point one thing out. I'm reading a lot of people that say you can't rally through harvest. Well, this is corn, and this is the beginning of last harvest. September 7th, we were up and gone. If we go back a year before that in 2020, August 10th, we were up and gone. You never had a shot to buy a pullback. So I don't know what this means, but I'm definitely not interested in completely closing the upside here, because it can just keep going until you're until these highs are gone and just bury the shorts. In fact, that's what provides the fodder for a lot of these bull markets. Our traders are caught off balance, and they've got to scramble to go get right the market. All right, that is 20 minutes. It's a lot of information. Remember, there is risk in trading commodities and futures, and you should only do so in light of your own financial condition. I hope you guys have a terrific week. Call us if you have any questions at all. We're more than happy to help you navigate and reposition as necessary. We will talk to you next week. Have a great day.